One thing that you do not want to be when you're coming into an earnings call, right up to earnings, you don't want to be binary. So what does binary mean? It means I think it's going to go down. I'm going to buy puts, or I'm going to buy a put debit spread. Because if you're wrong, you'll lose the whole thing. So I would rather do one of two things. If I'm going to trade it to the downside, I want to get some kind of a credit or both so I can reduce my cost, reduce my exposure a bit. Or I want to put on some kind of a hedge in case I'm wrong. So if I really think it's going to go down, if I really, really think it's going to go down, then how about I go to 912 for that short. And then for this Friday, I'll put the hedge on way up here, like just in case I'm wrong. All of a sudden it pops like crazy after earnings. This makes money, pays for this mistake. If it doesn't, it was a small piece of insurance. So that's another way that you could do it. So let's just say I thought, okay, I think this will be the last version of it. Let's just say with Avgo, I'm going to take it easy. I'm not going to go too crazy here. We're 302. I think it's going to go down. I'm going to give myself to next week. I'll go to like 295, 290, and for $1.80. So that's not it's a reasonable trade to the downside, right? Next week's expiration, 295, 290, we're at 302. Cost me $1.80. Okay, fine. But what if I'm wrong? What if this week it just screams higher? Well, then you come over here. If it screams higher and you're that wrong, you go over to Soxal, which is super cheap. You go buy yourself this Friday's expiration call. And you buy something like, the 26 halves for 16 cents. Look at the insurance that you can get for 16 cents. Because if you're right, or if you're wrong, and this shoots through the moon because Avgo just puts on 10, 15% after earnings, this is going to quad, either 4x or 5x. Right? So you're going to make at least 100 and whatever something dollars. Let's say you make $100 from it. And you paid what? 180 for the other one? You just mitigated a huge amount of your loss. Even if you made 90, you mitigated half your loss. If you could dump this thing, for 80 cents, and you lose $1, and you could make 80 cents off of this one, you got a wash. At least you have some insurance. You have some protection. So that's a cool way of doing it, is you take your main trade, wherever that is, to whatever direction, and then find a cheap way to play the other side short term. I mean, you do this Friday, and this ends up being next week's trade. I'd probably do this kind of trade more than anything. Short-term hedge, cheap. If I'm trading something in big tech, I'll use SQQQ. And I'll trade, calls on that, because this is the inverse of the Qs. But you could get SQQQ calls for like 20 cents, 30 cents. And so if tech shoots up, oops, I was wrong. I was shorting Meta through an earnings call or something. I could pick up some SQQQ and trade the inverse. Same you could do with the Russell if you wanted to trade. If you're trading regional banks, if you're trading real estate, home builders, something with some size to it, Toll Brothers or D.H. Horton, or something in the housing market, you could go to an ETF. You could do KRE if you wanted, which is regional banks, or you could do the inverse of the Russell, because that's what they're all underneath, and you could trade TZA. That's the inverse of the Russell. And these, again, 15 to 20 cents. And these have 4x, 5x potential if you're right. Great way to insure.
Thanks for watching. Hope you enjoyed this video from Trade With Me Now. Make sure to go ahead and like this video and subscribe to our channel so you make sure that you catch our next video right when it's released. Also, if you have a question or comment, please leave that in the comment section below. And of course, if you want to learn more about Trade With Me Now or join our community of profitable traders, go to tradewithmenow.com. There's also a link in the description below.